If you think the next financial crisis will warn you with some new and original signal, I think you are already too late. That is the first thing I want you to understand. Crises almost never arrive as surprises to people who have lived long enough to see the same machinery under different paint. The language changes, the headlines change, the villain changes, the asset changes, but the underlying structure is usually the same. Cheap money or excess liquidity distorts behavior. People begin borrowing and speculating against a future they have not earned. Prices detach from discipline. Risk gets renamed as opportunity. Then something shifts, rates rise, cash flow weakens, refinancing shuts, belief breaks, and all the people who thought they were holding wealth discover they were often holding timing risk dressed up as genius. I have lived through enough of these episodes to distrust every claim that says, "This time is different," unless the speaker can explain exactly why the basic laws of leverage, liquidity, and human greed suddenly stopped applying. They rarely can. That is because the laws did not stop. Only the packaging changed. The source document you gave me is built around exactly that pattern. It describes 3 major collapses across different decades, explains how each one looked different on the surface, and then makes the deeper argument that once you understand the repeating chain between inflation, interest rates, liquidity, speculation, and policy response, you stop seeing crises as random accidents and start seeing them as slow-moving setups that reveal themselves long before the public admits what is happening. Phaephilosite Phaeturn 57 File 0 Phay, that is the right frame. Not panic pattern recognition. Most people study a crash only after it becomes a history lesson. I prefer to study the conditions that made the crash possible before the public has agreed to call them dangerous. That is where the real money is made, not in hindsight, in posture. So I want to take you through the same arc in a much more useful way, not as a list of dates, as a set of mechanisms, what always happens before a financial crisis. First, policy or money creates distortion. Second, that distortion flows into one or more asset classes. Third, the public mistakes the temporary rewards of the distortion for proof of a new era. Fourth, leverage expands into the opening. Fifth, when the system tries to correct itself, it exposes every decision that only made sense under the old conditions. That is the sequence. And every generation gets seduced by it because each crisis feels unprecedented to the people who did not live through the one before. The first crisis I want to talk about is the one that taught many people the most basic rule in all of financial history. Inflation does not merely make life expensive. It rearranges the entire banking system. The source file begins in the late 1970s and early 1980s, when inflation rose to punishing levels, interest rates exploded upward, the federal funds rate became breathtakingly high, and the United States was still living through the aftershocks of war spending and the move away from the gold standard. The core lesson there is simple and important. When too much money is pushed into the system and inflation gets out of hand, the Federal Reserve eventually tries to break inflation by raising rates so violently that both households and financial institutions are forced into conditions they were never built to survive. Phaephilosite Phaeturn 57 File 0 Phay, that is exactly right. People think inflation is mostly about groceries and gas. Number inflation is a systems event. It changes the demands depositors make on banks. It changes what borrowers can refinance. It changes what debt costs. It changes what assets still make sense. At old prices, when inflation is high enough, savers stop accepting low yields because low yields mean guaranteed loss in real terms. That creates pressure on banks. Banks must pay up to keep deposits. But what if those same banks already lent out money at older, lower rates? Now you have the oldest banking mismatch in the world. Short-term liabilities resetting upward, long-term assets earning too little. The source text explains the savings and loan collapse through exactly that mechanism. Depositors demanded higher rates to keep money in the bank. Institutions had to offer much more to keep funding, but many of their legacy loans were still priced too low, which squeezed the entire model until hundreds and then thousands of institutions failed over time. Phaephilosite Phaeturn 57 File 0 Phay, that is a beautifully clear lesson. A bank does not need to own fraudulent assets to die. It can die because its timing is wrong, because its liabilities move faster than its assets, because the world it lent into no longer exists, but its balance sheet has not caught up yet. That is one of the deepest truths in all of finance. Many institutions fail not because they are evil, but because they are built for yesterday. S regime, when the regime changes, yesterday, S logic becomes today. S poison. That is why inflation is so destructive. It is not just that prices rise, it is that the correction of inflation through rates exposes every structure that only worked when money was cheaper. That applies to banks. It applies to households. It applies to property owners. It applies to governments. And one of the most important observations in the source text is that people with fixed-rate hard assets often came through that era far better than renters or people sitting purely in cash. The file's broader point is that when inflation tears through the currency and rate structure, ownership of real assets with fixed debt can become a tremendous advantage, while people without dry powder or hard asset exposure often watch the opportunity pass by from the sidelines. Fay file site, Fay turn 57, file 0 Fay. That is the first great crisis lesson in inflationary breakdowns. Ownership matters more than commentary. The person with fixed-rate debt on a real asset often survives the repricing very differently than the person with no asset, no leverage advantage, and no liquidity. This is not romance. It is structure. The reason I care so much about these episodes is that they taught a brutal but useful distinction. A crisis is not just a period of pain. It is a transfer. The weak balance sheet transfers opportunity to the strong balance sheet. The unprepared transfer advantage to the prepared. The person with no cash and no access spends the whole event trying to survive it. The person with cash, network, and clarity spends the same event choosing what to buy. That is what the source file means when it describes government liquidations and distressed asset opportunities during the aftermath. Its point is not merely that many institutions failed. The point is that people with position, liquidity, and courage were able to buy real assets at extraordinary discounts because everyone else was too damaged or too frightened to act. Fay Felicite, Fay turn 57, file 0 Fay. That lesson never leaves you once you really see it. Crises feel like disasters to people who enter them naked. They feel like markets on sale to people who enter them prepared. Same event, different structure. Now, let us move forward to a different kind of collapse because not all crises begin in hard assets or banking mismatches. Some begin in stories. That is what the second major episode in the source file really teaches. The dot-com collapse did not look like the inflationary banking breakdown of the prior era. It was sexier, cleaner, more glamorous. That is what makes speculative manias so educational. They always arrive with a story that flatters the intelligence of the people participating. The source document describes the late 1990s and early 2000s as a period where prices in technology and internet-related assets rose violently, fundamentals became secondary, profits became optional, and people bought because things were going up rather than because businesses were producing real, durable value. It then notes the enormous destruction in paper wealth when the bubble burst. Fay file site, Fay turn 57, file 0 Fay. That is a perfect summary of what a narrative bubble is. Not every bubble is built on debt in the most obvious way. Some are built on imagination, financed by loose enough capital and group psychology. A narrative bubble says this: the future is so extraordinary that valuation discipline is old thinking. The product is so exciting that profits can come later. The market is so transformed that normal ratios, normal caution, and normal skepticism now make you look outdated. That is when I become very alert, because what is called vision in the late stage of a bubble is often simply the suspension of arithmetic. And arithmetic always returns. The public thinks a bubble is merely prices going too high. That is too shallow. A bubble is when the social penalty for skepticism becomes greater than the social penalty for stupidity. That is when dangerous things happen, because once skepticism becomes socially expensive, more people stop asking the questions that protect capital. How much does this company actually earn? What would justify this multiple? What happens if rates rise? What happens if capital stops flowing? What happens if everyone discovers at once that the future is real, but the price paid for it was still absurd? That is what happened. And the source document makes another point that matters enormously. This crash was primarily a paper asset crash. It did not immediately destroy the banking system or real estate in the same direct way. The damage was concentrated in speculative equity and wealth built on narratives rather than cash flow. Fay file site, Fay turn 57, file 0 Fay. That distinction is important. Not every crisis hits every asset class at the same time. This is one reason the public stays confused. They think one area looking fine means the whole system is fine. Not true. A crisis can begin in a narrow lane. It can destroy trillions in one part of the market while another part still looks stable. That does not make it less real. It just means the transmission path has not yet widened. And here we arrive at one of the most dangerous things governments and central banks do after a crash. They solve the current pain in a way that plants the next one. The source file makes this argument very explicitly. In response to the collapse in speculative technology, wealth, and the fear of deflation, the Federal Reserve slashed rates dramatically. That policy choice may have cushioned one problem, but by making money extraordinarily cheap, it also helped light the fuse for the next, much larger housing and credit bubble. Phaephilosite, Turn 57 File 0 Phay. This is one of the deepest recurring patterns in modern finance. A correction reveals excess. The authorities respond by making money cheaper. Cheap money restarts risk. Taking in a different lane, a new bubble forms. Then the public forgets the last lesson because the new lane feels unrelated. But it is not unrelated. It is a continuation. The disease migrated. The medicine bought time and shifted the location of the weakness. That is what people miss. They think crises are isolated. Often they are chained. One response becomes the soil of the next distortion. So now we arrive at the third major episode in the source file, the global financial crisis. Here the chain becomes painfully clear. The file traces the path from low rates after the dot-com bust to surging borrowing, to a broad political and financial push toward expanded homeownership, to loose credit standards, to a swelling housing market, and then finally to defaults, collapsing prices, foreclosures, and a mass return of millions of households from ownership into rental housing. Phaephilosite, Turn 57 File 0 Phay. That is exactly how the system worked. Low rates are not neutral. They do not merely help people. They encourage borrowing, they encourage risk-taking, they encourage the belief that assets funded cheaply will continue justifying themselves because the financing conditions remain generous. Now add to that a strong social story. Everyone should own a home. Home ownership is virtue. Home ownership is social stability. Home ownership is national policy. Those slogans may sound noble, but when they combine with excessively easy money and poor underwriting, they become an accelerant. This is why I always say policy intention is not the same thing as economic outcome. Helping more people buy homes sounds wonderful, but if you lower standards too far and let people finance what they cannot sustain, then the help becomes a deferred crisis. The house gets bought, then the rates reset, then the cash flow fails, then the social ideal turns into foreclosure inventory. The source file uses vivid language here, especially around people who could fog a mirror being able to buy a house. Strip away the phrasing and the lesson is solid. When credit standards collapse and political pressure pushes access faster than underlying borrower strength can support, a housing market stops being a market and becomes a delayed liquidation event. Phaephilosite, Turn 57 File 0 Phay. That is exactly right. And once the liquidation starts, it changes everything. Homes flood the market. Prices adjust downward. Borrowers become renters again. Rental demand surges. Multifamily and distressed real estate become a totally different game. This is another reason I keep saying crises are transfers, not only disasters. The household who bought at the wrong time, with the wrong debt under the wrong assumptions, experienced the period as devastation. The investor with liquidity, outside capital, or enough nerve to buy quality real estate after a broad repricing experienced the same decade very differently. The source text makes this point forcefully through its own examples of buying distressed multifamily when others were fleeing, emphasizing that the best deals appeared when the headlines were worst and the psychology was weakest. Phaephilosite, Turn 57 File 0 Phay. That is how it always works. The best bargains rarely arrive in emotionally flattering conditions. They arrive when the public has confused fear with truth. This is why crisis preparation is not mainly about being right publicly. It is about entering the period with dry powder, stable financing, and a mind calm enough to distinguish temporary panic from permanent impairment. Now I want to pause and tell you what the 3 episodes together actually teach. The 1980s episode teaches that inflation and rising rates can destroy institutions whose balance sheets were built for a cheaper world. The dot-com episode teaches that paper asset bubbles built on story rather than earnings can vaporize fortunes without immediately hurting everything else. The housing crisis teaches that cheap money, social permission, and overextended credit can rewire an entire nation's balance sheet and then break it. Different costumes, same architecture. What always happens before a financial crisis? Some form of excess becomes respectable. That is the answer. Sometimes the respectable excess is money printing and easy assumptions about inflation. Sometimes it is speculative growth without profits. Sometimes it is cheap debt plus a moral story about why everyone should buy the asset. But excess always comes wearing respectable clothes by the time the public joins it. That is why the public joins. If the excess still looked obscene, fewer people would touch it. Real bubbles mature by becoming normal. That is when they are most dangerous. The source file is especially strong when it argues that these things move slowly enough for attentive people to see them. It says the signs are visible in policy, in rates, in refinancing pressure, in debt structures, in defaults, in transaction math, and in the way political language starts converging around affordability, homeownership, and lower rates. Fay Filosite Fay Turn 57 File 0 Fay. That point matters a lot. People like to say crises are unpredictable. The exact day is often unpredictable. The setup rarely is. The setup is visible in the tea leaves long before the newspaper says crisis. That is why serious investors do not spend their lives trying to call the exact bottom or the exact headline. They study conditions. They study debt maturities. They study rates. They study what kinds of assets become impossible to refinance under the new regime. They study who is taking the haircut, the borrower, the bank, the equity owner, the public market. That is where the real information lives. Now let us talk about today, because the source file ends by saying very directly that many of the same ingredients are visible. Again, higher rates, political pressure for lower rates, commercial real estate distress. Loan maturities hitting structures that were financed under an easier regime. Assets trading at material discounts to just a few years ago. The document says bluntly that the correction is already happening and that many deals are under stress right now, even before the public fully admits the scale of the repricing. Fay Filosite Fay Turn 57 File 0 Fay. I think that is the right way to look at it. Not as one giant future event, as an active process. The public wants the crisis to announce itself with a siren. That is not how the market works. The market starts repricing first. The distress appears in maturities and extensions, in transactions that do not clear, in assets that no longer make sense at the old values, in borrowers who are suddenly negotiating with lenders from a weaker position, in lenders who are choosing between pretending and recognizing. That is what a real correction looks like before the news catches up. And there is another point in the source file that deserves emphasis. Policy pressure to lower rates can create a powerful new buying window if it arrives while assets are already discounted. The file uses this idea to explain why periods of high rates followed by lower rates can be so explosive for prepared buyers. Fay Filosite Fay Turn 57 File 0 Fay. That is a real pattern. If rates fall materially after a repricing, and if the assets were bought under distressed conditions, then the combination of lower financing costs and recovering values can produce extraordinary outcomes. That is why the greatest money in many cycles is made, not by avoiding the storm entirely, but by understanding which assets are being repriced, why they are being repriced, and whether the repricing is temporary enough to justify stepping in. That said, I do not want to romanticize crisis investing. It is not a movie. It is not about swagger. It is not about chanting that the collapse is coming while sitting on social media feeling smarter than everyone else. It is about discipline, liquidity, underwriting, nerve. And most of all, a clear distinction between arithmetic and emotion, because the crowd is always emotional in a correction. The crowd extrapolates. If prices are down, they must go down forever. If financing is difficult, it must remain impossible. If the news is bad, then all risk is the same risk. That is how opportunity gets created. Not because the assets are perfect, because the market stops pricing them with proportion. Now let me tell you what I think the real lesson is for an ordinary intelligent person watching all of this. You do not need to become a macro pundit. You do not need to predict the exact month of the next recession. You do need to stop believing that crises are random lightning strikes that no one can prepare for. That is a comforting lie for passive people. Real investors know better. What you should be watching are the repeating ingredients: inflation pressure, rate pressure, refinancing risk, policy response, asset classes funded under old assumptions, narratives detached from earnings, Political pressure to broaden ownership without always broadening prudence. Those are the signs. And when enough of them line up, you prepare, not theatrically, practically. Reduce personal fragility. Avoid stupid debt. Build cash. Know what you own. Know how it is financed. Be especially careful with anything that only worked because the old rate regime made the math easy. And if you are an investor looking for offense, study the places where refinancing, liquidity, and public fear are creating real discounts. That is where cycles pay the attentive. The source file says investing is 10% math and 90% psychology. That is a colorful simplification. But the core idea is true enough to matter. Numbers do matter. But what usually stops people from using the numbers correctly is fear, recency, ego, and the inability to act when acting still feels uncomfortable. Fay Felicite, Fay turn 57, file 0 Fay. That is why I care so much about psychology. Not because I like self-help language, because markets punish emotional weakness with extraordinary efficiency. The people who win big in the aftermath of a crisis are rarely the ones with the best headline predictions. They are the ones who can still think when everyone else is reacting. That is what I learned from every major collapse. Not that pain is avoidable, that cycles are legible, not that there is no risk. That risk becomes most attractive when the public has already paid the emotional premium. Not that the future is certain, that repeated policy and human behavior produce repeated patterns. So here is the final truth. What always happens before a financial crisis is not one specific chart pattern or one politician making one speech. What always happens is simpler and more human than that. People get comfortable with the distortion, then they build around it. Then they call the distortion normal. Then the distortion becomes policy, story, product, and identity. Then something changes, rates, liquidity, cash flow, confidence, and the whole structure starts revealing what it really was. That is the pattern. The names change, the underlying lesson does not. So here is the final choice. You can keep treating each cycle like a brand, new mystery that nobody could have seen coming until the headlines were already screaming. That is what most people will do. Or you can do the harder thing. You can learn the chain. You can study how inflation becomes rates, how rates expose bad financing, how bubbles detach from fundamentals, how governments and central banks respond, and how one crisis often plants the seed of the next. Then you can prepare your own life and your own portfolio accordingly. That is the smart path. Not fear, not bravado. Pattern recognition backed by patience. And if you do that well enough, then when correction number 4 or 5 or 6 comes, you will not have to ask what is happening. You will already know what always happens before it does.